Guys, very quickly, I have 5 minutes to show you what we're gonna do. Palantir. So it kind of disappointed at earnings. We disagree with that. We think that the company long term is gonna do really well. I'm not gonna get into the earnings. We're gonna do a video in this one, but we can do probably a trade which could be good for long term. So look, this is the chart, and this is what happened today after earnings, and this is the average, the 50 average. So I think the stock now is roughly slightly below that, but anyway, still on this. Okay, what we're gonna do? We're gonna sell a put, and we're gonna have a limited downside by also covering this put. So it's not gonna be a naked put. It's gonna be a spread. Okay, a vertical spread, and I call this vertical spread bull put. Okay, you can call it whatever you want. So, but basically, is a spread in which you sell a put and you buy another one, so that you have a limited loss. When you sell a naked call, and sorry, a naked put, you can lose. The stock can go to zero. But if you cover by buying a put below the one you sell, you basically you cannot lose money below that strike. Let me explain to you what I need. So what I'm gonna tell you. So this is the first thing. So we're gonna go and try to look for something with a margin of safety below this number. So I went here on option profit calculator, which is a free calculator that you can use online. It's not the best one. I mean, obviously the paid calculators are better, but that you can actually. I want to teach you how to do that. So I put here the symbol Palantir. So I got here. You can select the put available. I checked something like not too far away. So April, it's okay. Don't forget that put within after 45 days the theta of the put get down quicker. So the put, the value of the option in this case after 45 days, I mean within the 45 days, start to dramatically erode quicker the value of the put. What it means is that your put will be less and less valuable every day in a faster way, so that obviously if you're selling that, you will be making the money. We're gonna go deeper in this concept. Just now is looks a bit more advanced, but I want to just show you what I'm trying to do. So I'm gonna sell the 28 put. I'm gonna sell 10 contracts, which is basically $28,000, and I'm gonna get a credit for that. When you sell a put, you get a credit. Okay, so you get paid for selling a put. You're selling it, somebody's buying to protect themselves, so they're paying you. So it's like you are the person that is insuring them uh, against a loss. Now you're gonna get this. So you're gonna get $4,880. Okay, but what you're gonna do to avoid to lose all the $28,000, well, minus the 4,000 you get, so to lose the, let's say, the 23,000, what do? You buy a put at 21 strike. Okay, so you buy this for 1.52. So in this case, for the 10 contracts for 1,520. Remember, one contract is 100 shares. So 10 contract is obviously 1,000 shares. Okay, so because you buy this, you cannot lose money below this. Okay, so you put here the stock range, you calculate it, and you see that this is the graph of your operation. What this graph means? Well, this graph means that anything that happens, if the stock stays above the strike price, okay, you're gonna get the credit. What is the credit? The credit is whatever you got from selling the put minus whatever you paid buying the put. All right. So this is 4,880, because that's the credit, minus what you have to pay to cover yourself from 21 downwards, which is 1,520. Okay, so you get basically 3,360, which is $3.36. If it's on one contract, you multiply by the 1,000, 3,360. So 3,360 would be whatever you make if the stock stays above 28, and obviously the break even would be 24.64. Okay, and that makes sense, right? So it's the 28 minus the 3 36. Okay, so if the stock goes below that, then when you're starting to have losses. Okay, why? Well, because you're not covered until 21, so you're gonna lose all the money that goes from 28. Sorry, from 28 minus the 3 that you get. So from 20, from 24, 64 to 21. Okay, so this is the maximum loss you can get. All right, and this loss is 3,640. So basically it's almost like a bit more than what you get if it stays above. Okay, you can see here obviously that depending on the day, okay, these things move. So this is um, a bullish, sort of bullish, not extremely bullish, but it's sort of bullish trade, because it means that you want the stock to go up or anyway to stay above that. It's not very bullish in the sense that if you're really, really bullish, if you think it's going to go to 50 or the 30 quickly, obviously you're going to buy a call or do any other type of trade, buy the stock or any other type of trade. But what you're trying to say is that you saying, I don't think it's going to go below 24. And if it goes, if it goes, you can do many things. You don't have to necessarily lose the money. For example, if this goes down below 23, what I will do is I will make money from this one. I will close this one, this leg, take the money from this one, and then I'll buy the stock. And the stock at that point will cost me the 28 minus the 488 plus whatever I gain from this one. Okay, that's more complicated. If you don't have the money to do that, what do? You just obviously you can close. You can close when it goes below this, and you can lose the 3,640. That's the maximum loss you will get. Okay, but I will play it differently. I'm covering myself because I think if this goes below, I can probably, this can go in the money, or it probably can just go and make a profit, and I can close this one making a profit, and this one will reduce. Okay, it will actually increase the credit I got for the selling the put, because if the stock goes dramatically faster, goes down lower than the 20, then 28, if you start to go, for example, I don't know, to 24 like very quickly, okay, what happens is that this one will be in a loss, okay, but this one will be in will be gaining a profit. So what you can do is you can only close one leg. For example, you can close these making money, and that will help you to basically lower the price that you're gonna get this for. So I mean, if you sell a naked put, you're gonna get a 488, and you're gonna basically get a price of 28 minus 488. Okay, but you are exposed, right? So in this case, you're not exposed because you cannot lose money below 21. So this is the graph, and this is the operation. And if by April the 16th, the stock's gonna be above 28, you're gonna make this money, and the break even will be above 24. So it's a fantastic price for Palantir. So if you don't have 28,000 to put in your portfolio to buy the stock anyway at 24,000, then you can use this spread, this vertical spread, which is called I would call it a bull put or vertical spread. Okay, and this spread will allow you to make $3,660 if it stays above 28, and to only lose maximum 2,640. How would I play that? If it goes down below, I would not be worried. I would probably let it, unless the market is not dramatically going down. The issue is that when the market goes down, if you have a strong sell-off, everything's gonna come down. So if you sold Vega, because you're selling volatility, and volatility will increase, your portfolio can have a problem. So at that point, if you have a strong sell-off, probably you can close the position, and you'll probably close around here, and you probably lose a couple ground. But the risk reward seems pretty good. I think this stock can bounce. If the stock bounce back in the next few weeks, for example, around the 30 or 32, you will be making already easily a couple $1,000. And if you worry about the sell-off, you can probably close it, with a couple $1,000 around here, for example, with a couple $1,000 gain if you want to. You can also play differently. So it's up to you. So I hope that helps. Optioncalculator.com if you want to learn how to do that and play a bit with different strike. You can play with different strike and different things. And please ask questions or come join our channel, and you can ask us directly questions about how to play with option spread, options, or any other type of strategy with option that you like. Thank you.